There are only two basic types of stock options: calls and puts. Understanding the difference between them is the foundation of options trading. A call option generally gives you the right to buy a stock, while a put option generally gives you the right to sell it. But here's the important part: you don't have to buy or sell the stock just because you own an option. That's one of the biggest differences between options and simply buying or selling shares of stock. Instead of buying the shares immediately, you could purchase a call option connected to that stock. For example, imagine a stock trading at $100 per share. Now let's execute. You purchase a call option. This option has a strike price of $110. You purchase a call option with a strike price of $110. The strike price is simply the price at which the option gives you the right to buy the stock. Now imagine the stock rises from $100 to $130. Your call option has become more valuable because you have the right to buy at the lower strike price. The difference between the stock price and strike price is called the option's intrinsic value. But remember, that isn't automatically your final profit. You also paid a premium to purchase the option. The premium is the price you pay to obtain the option contract. Now let's flip the idea around and look at put options. A put option generally gives you the right to sell a stock at a predetermined strike price. So why would someone want that, right? Usually because they expect the stock price to fall. Imagine the same stock is trading at $100. Now let's see how that affects our call option. Let's see how this works. This time, you purchase a put option with a strike price of $90. This gives you the right to sell at that price. Now imagine the stock drops sharply from $100 to $60. Your put option can become more valuable because it gives you the right to sell at the higher strike price. Your put option can become more valuable because it gives you the right to sell at the higher strike price. The difference between the strike price and the stock price represents intrinsic value for the put. So here's the simplest way to remember the difference. Calls are generally bullish, while puts are generally bearish. If you believe the stock could rise, a call may fit that market view. If you expect a decline, a put may fit it. But there's another important distinction. Buying an option and selling an option are completely different strategies. When you buy an option, you pay a premium for the rights contained in that contract. When an option is sold, the seller receives the premium but takes on contractual obligations. This is where options become much more interesting and potentially much more complex. Another concept beginners must understand is expiration. This is the date when the contract becomes void. It is critical to monitor this closely. Let us review how it impacts your trade. That means being right about the direction isn't always enough. Timing can matter too. Every standard option contract has an expiration date, after which the contract no longer exists as an active option. A stock could eventually rise, but if the option expires before the expected move happens, the result can be very different. There's also something called time value, which reflects the possibility that the option could become more valuable before expiration. As expiration approaches, that time component generally decreases, all else being equal. This is one reason options behave differently from simply owning shares of stock. So remember the core idea. A call gives the buyer the right to buy, while a put gives the buyer the right to sell. Calls are commonly used when traders expect upside, while puts are commonly used when traders expect downside. But options involve more than simply predicting direction. Strike price, premium, volatility, and expiration can all affect the outcome. And that's exactly why understanding the basics before trading is so important. In the next episode, we'll break down one of the most important numbers in options trading, the strike price. Once you understand strike prices, you'll start seeing exactly how options contracts are priced and why their values change.